Welcome to the monthly 3-Edge View from the Edge for May 2024. I'm Fritz, the Chief Investment Strategist here at 3-Edge. Joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. Today, Eric and I will provide our most recent outlook for the markets, and as you know, that is based on our proprietary 3-Edge research model. Last month, developed market equities struggled. U.S., Europe, and Japan all down over 4% for the month. Emerging market equities fared better thanks to a stellar month of performance from China. Chinese equities are up over 5% in April. In India, Indian equities were also positive for the month, rising by about 1%. We continue to have economic data that shows that the labor market remains strong, although perhaps cooling some in April. We have reports of positive earnings growth in the first quarter, and inflation still stubbornly above the Fed's 2% target. So Jay Powell's comments at the last FOMC meeting suggested that the Fed may need to leave interest rates higher for longer. And interestingly, the Fed funds futures market is now calling for only one rate cut before the end of the year, which is down incredibly dramatically, not to be overstated, from the 6, if you remember. The market was looking for 6 rate cuts at the beginning of this year in 2024. So that is definitely out the window. So let me bring Eric into our conversation to get right into it. And Eric, let's look at our asset class matrix to get started and see what may have changed since the prior month.
Great. Thanks, Fritz. Yeah, so the asset class matrix here, we're probably seeing more bullish, mixed to more positive outlook for most asset classes than we've seen in quite a while here. Only a couple of changes that we're noticing here. Developed Asia moving up to that +1 camp alongside the U.S. And India moving up to that +1 spot as well. Everything else more or less hunkered down where it's been. Gold and commodities still, commodities being a bit more mixed, but gold still having that positive outlook as well. So I'm sure we'll cover these in greater detail.
Absolutely. So let's get started and look at the major asset classes in detail. And let's begin with U.S. equities. And one thing I think could be interesting, and that is that I know in investment committee, we do talk a lot about how this U.S. equity market, like the S&P, is really so driven by momentum and investor psychology. So along with the sort of bringing us up to speed as to the outlook, maybe you could just briefly touch on how does our model pick up investor behavior and maybe make that connection for us?
Happy to do it. Okay, so after U.S. equities posted that very strong first quarter, we saw things come off a bit in April, as you alluded to. So what are we seeing here? Our model research continues to indicate that U.S. equities could be at risk of a further profit taking due to recent changes in behavioral factors that we're just talking about. So that said, if we see these upward moves towards and perhaps even through that all-time high on the S&P 500 set in March 28th, the outlook might get more bullish on U.S. equities from our vantage point. Instead, if we retest this level and fail to move ahead in a sustained way, so I'm not just talking about ticking over it and then coming back down, that outlook could grow more negative, very behavioral, very on what we would call this inflection point for U.S. equities. With regard to investor sentiment or investor psychology, as we call it, we capture this in a few different ways to answer your question. So first off, we have more very standard momentum factors. We're looking at, moving averages over a variety of time windows. We also look at the acceleration or the rate of change of that momentum as well for each of those time windows. Beyond that, we have these nonlinear momentums. That is, momentums that are more binary. They're either adding value or subtracting value independently. Those are two different factors. And they have to be over and above critical inflection point levels to either turn on or to turn off. So that some of those can be at play as well, either making an asset class very attractive or very unattractive based on crossing critical levels and staying within defined ranges. And then beyond that, awesome. Beyond, there's more. There's more. We have our whole entire investor behavioral filter as well, where we're feeding in the combined valuation and economic projections into this behavioral filter. And essentially what we're doing there is breaking the moving average of a given equity index into 5 ranges of what we would call this investor psychology. Are you more neutral? Are you rising up and above, more in a rally? Are you overbought? Have you gone up too far, too fast? And the same on the downside. And so now that we've broken these different, psychological levels up, then we feed in our valuation and economic outlook as well to, determine how to treat that incoming projection there. So a little bit more moving parts in that side of the model.
Perfect. So that's exactly what I wanted to let people know is that, in these videos, we say, it's investor behavior driven. There's a lot going on in the model when we're talking about investor psychology. So thank you for doing that. So now let's cycle through the rest of the equity markets, beginning with Europe. What are we seeing in European equities?
European economies, continue to face many challenges. We've seen inflation come down somewhat and likely far enough for the European Central Bank or the ECB to begin lowering rates at their next meeting, which is highly anticipated at this point by market participants. So this is likely a net positive for the region, but it may take further rate cuts to help steepen the yield curve, to get that T-bill yield down low enough that you actually have a real steepening, at least in the measure, the way we calculate it, enough to be a positive contributor. So near term still negative, but potential for a more positive outlook down the road.
All right. So shifting to Asia and the Japanese equity market, where so much of the discussion is really centered around the weakening Japanese yen versus the dollar. What are we seeing there now?
Yeah. Japanese equities have definitely had to deal with some added volatility from the swings in the value of their currency, the yen. After declining towards that 160 yen to dollar level in April, there was an aggressive strengthening that followed, which suggested that the Bank of Japan, the BOJ, intervened to support the currency, perhaps to provide a floor at that 160 level, a level it had not weakened to in quite some time. So, that said, the overall model outlook is somewhat favorable for Japan with positive contributions from investor behavioral measures. We're seeing tightening credit spreads in the region. And the steepening yield curve measure, as a reminder, the BOJ did lift the short-term rate into positive territory. It's now a few basis points positive, the last developed market central bank to bring interest rates to come out of negative interest rate policy. So hopefully, potentially more good things to come in Japan.
Right. And what's the worst kept secret in the market is whether the Japanese intervened or not in their currency, right? They don't say they do, but everybody knows that they did. It's kind of amusing. All right. Now let's shift to emerging markets and China. What's our current outlook there?
Yeah, Chinese equities have had a remarkable rebound. They were down, over 10% earlier in the year. They finished through the end of April up positive 3% on the year, and they're continuing to climb further in May, up around, at least within the last few days, up around 10% on the year. So real bit of volatility there. Broader emerging markets have no doubt benefited from this turnaround in Chinese equities. Exports and imports are both, picking up steam in China. So there's this potential for a rebound that might be underway. And that would, in theory, the question is, will that offset these larger, more, what seem to have been steadier negative factors in China? You have weak domestic consumer spending, and that's largely all on the heels of the stagnant Chinese real estate sector. So the outlooks may be improving there, but still negative for us here in the near term.
Okay. Last equity asset class is India. And so what are we seeing there?
Yeah, similar to many of the other global equity markets that we've covered, right? India's equity markets are benefiting from this positive investor psychology and, broadly speaking, market momentum so far this year. Although India's equity market remains overvalued by our measure, these positive factors have been somewhat steady, which, indicates this continued positive outlook, less volatility from the actual factor contributions. In addition, the RBI, or the Reserve Bank of India, the central bank in India, may be inclined to lower short-term interest rates in the near term as inflation measures have gotten back into the target range within India, which that could provide a further boost to the outlook shorter term.
Excellent. All right, so let's shift gears, look at the bond market and the current interest rate environment, starting with the U.S. Treasury market. And I would mention that we did just write a commentary looking at interest rates and the basically the performance of U.S. Treasury since the summer of 2022, and they sort of hit that all-time low. And people have really suffered in that U.S. Treasury market over the past couple of years. So what is our outlook now for Treasuries going forward from here?
Yeah, no doubt U.S. Treasury market, broadly speaking, particularly anything longer in the curve, has struggled in this year in 2024. We saw U.S. Treasuries with that intermediate and longer term maturity decline in the first quarter. They continued their decline in April, with the 10-year Treasury yield peaking mid-month at around 4.7%. And this seems to have a lot to do with the resetting of investors' expectations of rate cuts down to only one cut by the Fed by year end this year. As you pointed out, it started the year at 6. Now we're maybe 1. There's even some folks calling for a hike, although Fed Chair Powell has tried to quash that concept. The strengthening of the U.S. dollar and subsequent declines in longer yields that we've seen following that spike in April may lead to a near-term opportunity to extend duration if this trend continues back down for yields. But all that said, even if there is a potential shorter-term opportunity, we just find shorter maturities that continue to provide more attractive yields than at the longer end, just a better risk-adjusted position on the yield curve.
Yeah, absolutely. You're getting paid in the shorter end of the curve there, so it does make sense. So let's look at the corporate bond market real quick, also referred to as the credit markets. What are we seeing there?
Yeah, not a lot new here. We've been, pretty steady on our discussion of credit for quite some time. The inversion of the U.S. yield curve that continues to signal this risk of potential economic slowdown, and that just really isn't reflected in corporate credit spreads, which just remain near historic tights. So the outlook for the credit markets remains unchanged and cautious from our standpoint.
All right, great. Well, now we'll really shift gears and we'll look at hard assets or real assets, and that includes gold and commodities. Why don't we start with gold?
Yeah, price of gold has continued to rise through April, up over 10% on the year through month end. It's benefited from positive investor psychology and momentum measures. We've seen an increase in central bank purchases globally, potentially with the goal in mind of distancing themselves from the U.S. dollar dependence. We've seen rising political tensions. We've seen some short covering as well. So there's a number of things that have helped with the price of gold rise. You also have what's interesting as well, and we've noted, is the prospect of a decline in real, or that is inflation-adjusted interest rates. That could also be supportive of further gains in gold. We've seen prices rising in gold while real rates have been rising too, which is very unusual. So if those do turn around, that could just provide a further tailwind. So the outlook remains favorable.
Excellent. And then lastly, we have commodities. What is the model saying about the outlook for the basket of commodities?
Yeah, based on our research, the general outlook for commodities has improved to a more neutral outlook. You've seen investor sentiment in China potentially moving to this more positive footing that we talked about. Continuing global geopolitical conflicts, the rising price of gold, all collectively bode well for our commodities outlook. So in addition, should the value of the U.S. dollar decline, perhaps as the Fed prepares to lower rates or even talks about it, dollar-denominated assets such as commodities could benefit from that as well.
Excellent. All right, Eric, great. Thank you very much for providing our monthly view from the edge for May. Markets do feel as though they're somewhat suspended animation, sort of waiting to see when and if the Fed and other central banks begin to cut interest rates. So we'll do what everybody else is doing and wait and see. So with that, we'll do it for Eric and me. We will be back, of course, again in June with another edition of the monthly view from the edge. If you'd like a hard copy of our View from the Edge newsletter for this month, you'll find that on our website, and that's 3edgeam.com. Also, as a reminder, our video library content is always available on our 3Edge YouTube channel. If you think someone you know might benefit from our videos, please feel free to share them. So, on behalf of Eric and everyone here at 3Edge, thanks for listening.